David R. Guttery is the president of Keystone Financial Services in Trussville, Alabama. David Guttery is a financial advisor who represents Emeritus Investment Company, LLC, and Emeritus Advisory Services. Please stay tuned through the end of the video for additional important disclosure information.
Recently, many of you have asked similar questions related to Silicon Valley Bank, and it's being taken into receivership. I wish that there was a simple two-sentence answer that I could provide so that you would have a deeper and more clear understanding of an otherwise complex subject. I will attempt to provide that to you in today's podcast. For now, however, let me address some of the more straightforward questions that several of you have asked since Friday. First, no, I don't believe that you should withdraw your cash from your bank. Remember that the Federal Deposit Insurance Corporation provides $250,000 of insurance on cash deposits per person per institution. As long as the federal government can print money with impunity, then FDIC will remain viable along with the insurance that they provide. Secondly, remember that if the media is good at one thing, it is sensationalism. Right now, I would suggest to you that the majority of what you're hearing in the mass general media falls under that heading and not under the heading of actionable information. This week, I will post the most recent executive summary from the 2022 Federal Reserve stress test of major banks. I'm quoting to you from that executive summary now. The 2022 stress test shows that large banks have sufficient capital to absorb more than $600 billion in losses and continue lending to households and businesses under stressful conditions. In large part, this is due to the substantial buildup of capital since the 2007 financial crisis. The executive summary goes into granular detail and is roughly 66 pages long. However, the chart on page 9 of the summary provides a quick visual reference to the degree by which the banking system appears to be in arguably the best health from a common equity capital ratio standpoint since the financial crisis of 2007. Third, many of you have asked if this might be the beginning of another such financial crisis, and in my opinion, no, I don't believe this is the case. Over the last few days, I have absorbed the opinions of several economists and analysts in the financial sector. Through that research, and in my own understanding of the scenario at hand, I would like to offer my opinions about what's happening as it pertains to Silicon Valley Bank. On the surface and at a high level, Silicon Valley Bank is now in receivership because it was unable to consummate transactions. Well, how did that happen? It is a chartered bank of the Federal Reserve, and as such, it must adhere to reserve deposit requirements, and without going too deeply into that math, that reserve requirement is roughly 10% of deposits. To this point, we have only heard of one other bank, Signature Bank, suffering similar liquidity issues. At a high level, banks are allowed to take 90 cents of every dollar that you deposit and invest that money. Normally, that money is invested into other loans such as car loans, home equity lines of credit, credit cards, and other types of loans. That's leverage. That's the concept of banking. However, banks may also invest money into very narrowly defined other areas, including real estate and certain types of bonds. As recently as a few years ago, banks were clamoring for charters to be changed to include cryptocurrencies as investable securities. Thankfully, that did not happen. Interestingly, and I will unpack this as we move along, but in my opinion, that which undermines Silicon Valley Bank had nothing to do with toxic real estate loans or bad management decisions or exotic, hard to understand complex investments or cryptocurrencies. It would appear that theoretically riskless United States Treasury securities were at the crux of the illiquidity issues that forced Silicon Valley Bank into receivership. The Federal Reserve, since March of last year, has been desperately unwinding its balance sheet and removing accommodation post-COVID in an effort to avoid stagflation and hyperinflation. To that end, they must do several things. In my opinion, the two most important actions are unwinding a historically bloated balance sheet, and secondly, they must reduce the velocity of money. In order to do that, they must reduce the amount of money that is in the lendable supply. Think of it in terms of humidity. Over time, you will have a mold problem if you don't address the humidity. Well, if you have standing water on the floor, you've first got to mop that up before you have a chance at arresting humidity as you try to avoid a larger problem of black mold. The Federal Reserve spent 30 months printing a historical amount of money that caused the M2 money supply to mushroom to levels that none of us have ever seen in our lifetimes. That money was used to buy a record amount of Treasury bonds, causing the asset balance sheet to become historically bloated as well. Why did the Federal Reserve do this? They did it to fund all of the spending programs promulgated by Congress in an effort to keep the economy open after COVID. Both CARES Acts, Secure Acts, Infrastructure Acts, and other acts that funded such things as the EIDL, and both rounds of the PPP, and other measures that extended unemployment benefits and that paid companies not to close and retain employees. As the country goes more deeply into debt, the Department of the Treasury issues more bonds. The Federal Reserve bought those bonds with printed money. This money made its way into the economy as people were paid not to work, employers paid not to close, companies were paid to retain employees, and ultimately infrastructure projects were funded with subsequent stimulus acts. Literally trillions of dollars outside of any normal budget year were spent in a very short period of time, and now those dollars are backwatering in the banks. The Fed must do what it should to keep that money from finding its way back into the economy in the form of loans. Right now, the Federal Reserve is selling the bonds that it spent 30 months buying with printed money in the open global market. That alone is causing the price of those Treasury securities to drop sharply. As prices drop, yields rise. At this time last year, the yield on the 10-year Treasury was around 50 basis points. That is 0.5%. At least as of last week, that yield stood at over 4%. This is a huge increase in the 10-year Treasury yield, and one that is without historical precedent in such a short period of time. Comparing the yield of the 2-year Treasury with that of the 10-year Treasury, the yield curve, as we call it, is more inverted than at any point since 1981. It is inverted by more than 100 basis points. Since 1928, there have only been 3 times when we have had 2 consecutive negative years for Treasury aftermarket declines in prices. Prior to last year, the last time we saw 2 negative years for Treasuries was in 1958 to 1959. The decline that we saw from 2021 into 2022, cumulatively, was over 22%. The price of U.S. Treasuries in the aftermarket dropped 22% in 2 years. To give you an example, had you purchased a 10-year Treasury bond in 2020 with the intent to hold it for the entirety of the decade, then the U.S. government would have redeemed your principal upon the maturity of the bond. However, if you try to sell that bond in the secondary marketplace before it matures, then you might not get a full redemption of your principal. That's what's happening now. That 10-year Treasury bond that was purchased in the year 2020 could potentially be sold today maybe for 80 cents on the dollar. We have never in the history of the United States seen losses to this degree in such a short amount of time on United States Treasury aftermarket prices. The Fed only began to unwind its balance sheet in July of last year, and to date, it still remains historically bloated. In November of last year, I believe the Fed indicated the willingness to slow the pace of unwinding its balance sheet and in more of a gradual fashion over the coming years, but I doubt they will cease to pursue targets of tightening anytime soon. Because of this, I believe that prices will continue to decline. Yields will continue to rise as a result, and this will continue to have an impact on mortgages and costs of credit and everything else tied to a rising 10-year Treasury yield benchmark. So how does all of this relate to Silicon Valley Bank? In 2008, in response to the relatively opaque nature of bank valuations, a little-known accounting rule that we now call FASB 157 was passed. Financial Accounting Standards Board Rule 157. At an extremely high level, this requires banks to mark assets to market every day. This was a well-intended piece of legislation that was designed to give investors clarity into the financial health of banks and lending institutions. In 2009, though, when collateralized debt obligations became worthless, companies like Lehman Brothers, which no longer exist, packaged AAA grade debt with subprime debt and then sold that CDO as a AAA rated tranche obligation without telling investors of the risk involved with the subprime nature of the securities. This new accounting regulation forced banks to mark those assets to market, and sometimes at $0. What may have been purchased on the balance sheet for $1 in this example had to be carried on the books at $0 because there was no aftermarket for the collateralized debt obligation at that time. This required banks to take money that would have otherwise been used to make loans and hold it in reserve to cover losses that existed on paper due to FASB 157. Fast forward 15 years later, and this otherwise well-intended piece of legislation is having an impact again today. I mentioned earlier that the Federal Reserve is selling bonds in the open global market at a very fast rate. Well, they are also forcing Fed member banks, which they all are, to hold these treasuries in exchange for otherwise lendable money. Most banks have reserves that are in excess of the 10% requirement threshold, and this is because a record amount of money that was printed post-COVID is backwatering in those banks. And in an effort to control the velocity of money, the humidity in my previous example, they are forcing banks to exchange otherwise lendable money, the water in my previous example, for those treasury bonds that are illiquid. The banks must hold them. In theory, banks are perpetual entities. Therefore, the Fed is forcing them to own illiquid treasuries with the belief that this is a riskless proposition, as they will be held to maturity, at which point the principal will be redeemed. No risk, right? Meanwhile, lendable reserves are being drained from the banking system as the Fed's effort to control inflation by controlling the velocity of money, by controlling the supply of lendable money. Considering FASB 157, though, as the Treasury aftermarket prices are declining in value at a historical rate, these banks are also having to take what's left of their lendable reserves and now hold that in escrow as well to make up for the fact that these theoretically riskless treasuries that the Fed is forcing them to own in exchange for lendable dollars are going down in aftermarket value. Silicon Valley Bank was also somewhat unique when you consider its relationships with multi-billion-dollar corporations like Apple, Microsoft, Oracle, and others. Let me offer a very high-level example. You and I are both banks. We each have $100 on deposit. You have 5 clients with $20 deposits, and I have 100 clients with deposits of $1. Each of us have 3 clients that demand all of their money. This clearly hurts your bank to a much greater degree than it hurts mine. Furthermore, this isn't a scenario where the average person can't cash a $100 check in the lobby of a bank. This is a scenario where large, multi-billion-dollar corporations are demanding large transfers of cash electronically. When faced with the prospect of exchanging lendable reserves for illiquid treasuries, and when those treasuries are declining in value, invoking the wrath of FASB 157, and when enough of your largest clients are demanding significant transfers of cash on deposit, the bank must impose restrictions on those withdrawals. When that happens, it can incite panic, causing more clients to demand larger withdrawals. So in conclusion, at this point, it would appear that the aggressive approach to tightening from the Federal Reserve may have played a part in the illiquidity of Silicon Valley Bank. In an effort to drain lendable reserves from the system as part of a larger effort to control inflation, the Federal Reserve required banks like Silicon Valley Bank to own treasuries in exchange for lendable reserves to an increasingly greater degree. As the prices of those treasuries continued to drop in the aftermarket, otherwise well-intended regulations like FASB 157 caused those banks to mark those assets to market, requiring them to hold increasingly greater amounts of otherwise lendable money in escrow to cover losses that existed on paper. Meanwhile, withdrawal demands from primarily large corporate banking relationships created a strain where it became impossible to consummate transactions. This prompted the state of California to receive Silicon Valley Bank into receivership in an effort to restore order. Drawing reference again to the most recent stress test of large banks from the Federal Reserve in June of last year, it does not appear that the banking system is unhealthy. However, I do believe that this has unveiled an unintended adverse consequence of the Federal Reserve's effort to tighten aggressively. The media will do what it does so well, but I would suggest that such is only going to exacerbate anxiety. I can't offer predictions on the potential for contagion, but from what I've read and from the findings of the most recent banking system stress test, it does not appear to me that this is the beginning of a new system-wide financial crisis. Last week was certainly challenging for the markets. Chairman Powell addressed Congress for much of the week, and the week ended with Silicon Valley Bank being taken into receivership. Clearly, markets can be volatile at times. I would strongly suggest that everyone distance themselves from the sensationalism of the media and remain dispassionately focused on quantitative metrics as we continue to pursue your financial planning goals and the objectives that we've identified. Please know that I continue to research this and many other topics, and I will bring additional opinions to you as such as warranted. Never hesitate, though, to give me a call at any time.
David Guttery independently offers securities and investment advisory services through Ameritas Investment Company, LLC, member FINRA, SIPC, and Ameritas Advisory Services. Information provided in today's segment is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.